Thank you very much. First of all, thanks to BGL BNP Paribas for having me here. It's really a pleasure to be in front of such an audience, and kind of a stress too. Thank you also for your presentation, which was very fundamental, very interesting, mathematically speaking. I'll just take the pointer. So I represent SESAMm, which is a FinTech startup, part of the Lux Future Lab at BGL BNP Paribas. And before really going into details and speaking about artificial intelligence in terms of emotions analysis, I want to speak about big data again. You heard about it last time, but it's really, really important. Nowadays, it's impossible to perform artificial intelligence tasks without using big data. So what is big data? There is a formal definition that was provided a few years ago. It involves either 3 or 4 V's, and it's very, very important in terms of asset management and stock market analysis. It involves large volumes of data in terms of billions of data points, a huge variety of data from text to videos to audio to any kind of information that can be extracted. And often big data applications involve a factor of velocity. They have to run real time, specifically when they concern stock market analysis. And considering this approach, and for me as an IT engineer, stock market analysis is fundamentally a big data task. It is a task where you have to analyze billions of data points in real time from various sources, both structured and unstructured. So how to use big data to really gain an edge in that context? That's kind of the holy grail in terms of what fintech startups are developing right now. Everyone is looking at this. But there are specific approaches that we apply and that can bring value to an investment process. So, big surprise, our approach involves emotions. What we are looking for is irrational contents that drive stock markets up or down. And we are looking at it on a very global scale, from the whole American population to the whole Chinese population to very specific groups of traders in a very specific board community. And the second thing that is necessary in that context to perform this analysis is, as mentioned before, big data tools. So this really goes together, the artificial intelligence part, emotions analysis, and big data tools. So I would first like to present some kind of use case. It's a very, very simple one, and it's not so well formatted, so I'm sorry for that. But it's really to show you what kind of indicators are extracted, because it can seem extremely technical, extremely subtle, but it can actually be represented in a very simple way. So we performed a small study on data on a social trading platform, mostly on prop traders, speaking about the market, speaking about companies, and we tried to look at very famous companies, Apple and Tesla. So the data set looks like this. We have messages, and for each message, we have specific analytics that we provide. We have primitive emotions, such as Ekman emotions, fear, anxiety. These kind of things can be interesting in terms of stock market analysis. Also, cognitive affective states like arousal, the sentiments that you know, positive, negative, neutral, which is called here valence, and some specific indicator that we can tune based on the analysis that has to be performed. So this is very trader-centered, and therefore we provided an additional bullish, bearish signal. Does the trader that is speaking right now want to buy or want to sell? So a pretty simple data set that is performed automatically, and we will see later how it is performed. What do we observe? So here are the curves for Tesla Motors and Apple. First of all, this kind of analysis on social trading data only works for companies that drive a lot of information. And Apple is specifically a company that will drive a lot of content in that direction, and therefore the granularity of these curves is much higher and much better. What we also observe, and that's really, really interesting, that's what really what we want to look at, is that there is an inversion in the bullish-bearish signal, in the bullish-bearish sentiment of traders that is highly correlated to an acceleration in the joy indicator. So we see that more primitive, more global emotions are highly related to what's happening in terms of trading sentiment. And this is extremely interesting to know more about Apple than simply the price, but maybe to know before the price happens, what are people that will invest in Apple saying about it. So that's really the point of this analysis. So we can, that's really the quantitative way of seeing this, extracting multiple features, multiple parameters, plotting curves, and performing statistical studies, and hoping that it is statistically relevant and that there is a causality parameter that we can extract. There are other ways to do this. In terms of risk management, for example, or portfolio analysis, it is possible to extract a global emotional profile for any company based on the amount of data that is available on the web. How are customers feeling about this company? How are people that are buying iPhones feeling about Apple? How are traders feeling about Apple? Is this company, all in all, a company that represents joy or sadness or surprise, etc.? And this is extremely relevant in an investment process. So let's go into detail. Very simple use case. So you now know what kind of indicators can be extracted using modern emotions and sentiment analysis based on IT techniques. So we'll go back to some kind of scientific background, but more centered on systematic trading. So the point is to show that it's a very diverse and very active field of research. The researchers that I present here are kind of old. So it's before 2011. So it's from the machine learning point of view, it's kind of old. So let's see how important it is and how active this field is. So the goal in that context is always to generate alpha based on textual data related or not to financial markets. The idea is pretty old. It was developed in 1998 with the first study like the one that you already presented that concerned extracting information from textual web data and trying to predict market prices. It's important to note that before 2010, all of the studies that were performed on information that was directly related to stock market prices. So you get information about Apple, and based on this, you analyze emotion, and based on this, you try to extract predictive information. But it's possible to go way, way, way beyond this. And how is it possible? It's possible using social media. Social media do not really represent stock markets. You do not have to extract information specifically about a stock, about a market, but you want to know what consumers are saying, how the global population is reacting to political or economical decisions that could drive specifically indices in one direction or in another. There was an article in 2010 that was not related to the stock market, that was about predicting blockbusters in terms of films. And that had a lot of success because people realized that social media could be seen as a platform not only to communicate, not only to share information, but also to perform statistical study. And from there, the research field exploded. There are hundreds of articles about that subject every year in American, European, Asian university. It's becoming an extremely technical subject, and it's getting very, very interesting and very relevant. I have two small examples here that are not part of the presentation. There are two very big funds in the US. You may know some of them. One of them is called Renaissance, and the other one is called 2Sigma. Renaissance was created, let's say, at least 30 years ago. It's a pretty old fund. They created the Médaillon Fund. And this fund was based on statistical analysis. At a certain point of time, they started recruiting every single guy performing natural language processing analysis at IBM. And their performances nowadays are huge, like 50 to 100% per year with 100 billion in assets. That's really, this really shows that it's possible to do this. It's just extremely complex and it involves a lot of technology. The other fund is 2 Sigma. They are working on 37 billion of capital right now, and they specialize on big data. That's exactly what they are doing. And again, their performances are enormous. This is really possible. There's really a possibility to still go into the field of active trading, not only smart beta, not only passive strategy, but active trading if you have enough technology. And we're not there yet. We're not at this stage, but this is really the direction that we want to take to develop this kind of information extraction, this kind of analysis. Okay, let's take a look at the examples that are specifically in the field of natural language processing and that concern emotion analysis. What are emotions? That's really a simple question, but it can be pretty complex, specifically when you ask that question to a scientist. So in terms of what scientists are saying, there is a good definition of emotion, which is called cognitive affective states. It involves what you all know from Netflix data, positive, negative, neutral, the number of stars, really simple. It also involves cognitive states, arousal, being calm or excited. This is extremely relevant in the context of stock market analysis. And, for example, primitive emotions, emotions that are related to every human being that are very general. There are even more formal and complex definitions. We are working on that right now. We have a PhD at the company right now in that context. Emotion is not something that is just about one sentence associated to one emotion. It's also associated to a context, to a certain period of time, etc., etc. So you now get the idea that mathematically and in terms of computer science, it can be pretty complex. We can go very, very, very deep. So let's take a quick look at the main problems that appear. Before you spoke actually about extracting specific words, comparing them with lexicons, and based on this, extracting information. This is what we called computational linguistics. And that's pretty old, actually. The new tendency here nowadays is to really extract rules to describe very complex processes, very complex statistical things that are happening in the data set. So let's take a look at a few problems that can appear and that you want to detect in order to make sense in that context. Negation. I'm happy, I'm not happy. Obviously, the word that is relevant is happy, but if you add the word not, it's not relevant at all anymore. I'm happy and I'm happy. That's not the same context at all, not the same thing. Even more complex, irrealis. I would be happy if. There is absolutely no word in that sentence that has an emotions value except for happy. And again, it is not really someone expressing the fact that he is happy. I'm so happy, irony. One of the worst problems for machines right now trying to understand text, understanding irony. I'm happy, but there is a sad face, so you do not really understand what's happening. Point of view, in terms of context, what I was speaking about before. My enemy is happy. Am I really happy about this? Not sure, again. This is a hard task. This is a hard stone. Again, there is another example when analyzing the word hard does not make that much sense anymore because there is really two different sense for that word. And a problem that has never been solved for now is common knowledge. It's about letting the machine understand that certain concepts are associated with certain values, for example. This car uses a lot of gas. Absolutely no emotional word, but everybody knows that it's not so good. And it could even depend on specific culture. Maybe if you go in the south of the US, it's not that bad, actually. So it's really something that is extremely complex. And to perform that kind of analysis, to extract these kinds of rules, it's nowadays absolutely necessary to use machine learning and more recently deep learning to perform these kinds of analysis. All right, a quick summary. It was pretty quick, so just to summarize. The point is, first of all, to extract information for big data, from big data. It is to go into the study that you describe, but to do it at a very general stage, to extract every information that could be relevant and that can be analyzed in a systematic way. The second part of this analysis is quantifying emotion, quantifying something that is fundamentally irrational. And lastly, the point is to extract information that is relevant to an asset manager, to a trader, to an investment banker. And it's about building predictive models. If you just get a joy or a fear curve for a specific stock, you may not be able to immediately extract enough information to make a decision. And the point is to build on top of that either statistical or machine learning models to make sense of that data. So lastly, what can emotions analysis bring to financial actors? The thing that it can really bring is new information about the market, information that goes beyond market prices, information that drive market prices. Thank you very much.
So thank you, Sylvain. Thank you, Yves, for a most interesting presentation. I will now give the floor to you for questions. There are no emotions about emotions. Ah, yes, please.
Thank you, Karine. Yes, my question is a bit philosophical, because let's assume that everybody who has enough money can pay for these algorithms. Then again, I mean, the stock prices everybody will then do the same thing, and will it really help in the end? I guess is the bottom line of my question.
Thank you. It's a very good question. It's something that I think will never happen, but it's the same kind of question as if everybody was just using ETFs, would the market move? It's the same kind of philosophical question. What we feel about this is that active asset management, active trading is really a zero-sum game. So if everyone has access to that information, you do not generate performance anymore. So the point is not to sell this to everyone and to be the best, if possible, in that kind of analysis. But I feel that at the end it would not generate performances if everyone had access to that.
Very interesting presentations. They seem to be quite early days in terms of AI and machine intelligence. I have a quick question. Are you ever tracking or heard or read or planning that to look into relationships, not just how the market performs or on specific companies, but relationships between two companies? I give you an example. SCS Astra is a satellite operator. Their shares dropped very dramatically because Eutelsat had a problem, and it was unrelated. Of course, would there be a relationship between Apple and Samsung when Samsung is dropping dramatically, does it, and so forth, in terms of sentiment?
We are not doing this specifically. I know a very good startup here in Luxembourg that is doing exactly this. And I read an amazing study, a scientific study about this recently. But to be honest, it's what I said. Big data and artificial intelligence are right now the holy grail in terms of asset management. I think every fintech startup tries to cover one specific aspect, and it's really, really hard to try to cover everything.
Am I allowed to have a quick follow-up? How much of the market is rational and emotion agnostic?
Very hard to tell. I'd say which market, in what context, when. So many questions to ask. If you want a number, I can provide one, but it won't be very relevant, I think. Just maybe one answer to that. For example, news, classical news, new information about the market is absorbed in around 40 seconds in the market. So that's really something to tell you that market as a whole is pretty efficient in terms of new information. And the rest of the performance that can be extracted without high frequency trading would be about looking at irrational things.
May I ask what kind of algorithm you are using? Is it the traditional machine learning algorithm, logistic regression, this kind of tools?
Good question, very good question. In terms, there are two types of machine learning that we are doing. On the emotions analysis part, which is really a natural language processing study, we are using both classical machine learning, SVM, logistic regression, random forest, this kind of thing, and deep learning. On the predictive model that we are using, we are not using deep learning yet. So to go from emotions to stock markets, we are not using deep learning yet, but we are using both statistical models and standard machine learning. Statistical model will be about ARIMA models, Garch model, these kinds of classical models in terms of finance.
Thank you.
I'm not sure I'm comfortable with sharing with such a great audience in terms of regulation too, but the results were the results have been good. There has been live performance generated, and a good live performance generated over the last 2 years with a partner in London, a hedge fund, and we're very happy about this. And if you have any further question, we can talk about it later.
I have a second question. You just said that the market takes 40 seconds to absorb new information. And a couple of minutes earlier, you mentioned mean reversion. So I've been thinking, if because very often when markets absorb information, especially if they do it within 40 seconds, it is likely that they overreact. And so, have you already studied the mean reversion from a quick news that is absorbed within 40 seconds, and depending on the language in that news, it is likely that mean reversion happens faster or slower, and I believe that could be a very interesting trading strategy, because I'm always asking myself, when the market absorbs new information, to what extent did it overreact? Is that something that you study as well?
I think it's very, very interesting, and I think Trump's election was a very good example of this, where the market rebounded 6% after dropping 5% in the night. This is not something that we do not exploit simply because we do not have the means to execute that kind of algorithm, which would be high frequency. Actually, we are looking at daily analysis, and when there's a very specific, very news-centered event, the point for us is to have good risk parameters. It's not possible for us to go that high frequent yet.
I'm not speaking of high frequency. I'm just saying, if you, let's say the news that triggered the market reaction, let's say the 6% drop, if you process the news announcements and you find out with your correlation, etc., analysis that some of the keywords in those tags have been used, and so a couple of days later the drop has already been corrected, or has been corrected to a certain extent, and then try to extrapolate from these empirical analysis to future events, and then looking at the words in the press releases or the news, and then build a strategy on okay, this stock is likely to either rebound or the drop is likely to accelerate. So I'm not speaking of high frequency, because you would have a couple of days or I don't know, or maybe 1 day at minimum to process.
Again, very interesting, but we did not perform that study yet. I'll speak about it with my team.
Just a simple question. Why do you consider, both of you, that emotions are irrational?
I didn't get that, sorry.
Why do you consider the emotion being irrational, non-human, practically?
I think that's a fair point. I think it's to some extent a matter of semantics, right? What you call rational and what you call irrational. But generally, the convention, let's put it that way, but you could have chosen a different convention in the finance literature, is that it's a Yes, but I mean, I guess the ultimate test is always whether there is whether you can predict returns based on things that are unrelated to fundamental value, and that's interesting, I think, if that's the case.
Just something that is more machine learning related in terms of irrationality and emotions. It's very interesting to know that human beings are only saying the same thing about emotion around 80% of the time. So it's not something that is perfectly quantifiable even by human beings. So there's really this aspect of personal, how you feel personally, how you really interpret this personally. So the goal of the algorithm is to reach the human interpretation of these emotions and to really go to something that is quantifiable. But there is still an aspect that is extremely personal about emotions, and that I think will never be quantified, because even human beings are not saying the same things.
Any other questions? Well then, let me thank again Yves Nosbusch and Sylvain Forté. I suggest we give them a big applause for really an interesting speech. Thank you so much. I'm left to invite you to join us outside for a drink, but also we put outside on the table the invitation to another conference on artificial intelligence, Key to a Glorious Future or the End of Mankind. You know that we always want to put things in a little bit of a provocative way, but I can really promise you also a highly interesting speaker. We are very lucky to invite our colleagues directly to attend now, because we have the big auditorium. Before we only had smaller space, so we couldn't invite our colleagues together with our clients and guests. But so please take advantage. It is on the 29th and on the 30th, and it promises to be also a really nice conference. Thank you again for joining us today for FinTech Meets.